Good morning, trader. I would be happy to guide you through the long call calendar spread strategy and provide the other information. Long call calendar spread, other name is call horizontal strategy. Strategy goal to profit from a stable neutral stock price over the near term, followed by potential move higher in the long term, or to profit from an increase in implied volatility Vega. This strategy is also used to reduce the net cost of buying a long-term call options. Step-by-step practical process in USA trading. Script title: Mastering the Long Call Calendar Spread. A step-by-step guide. Hello and welcome to our deep dive into the long call calendar spread, also known as the call horizontal spread. This strategy is a sophisticated way to profit from the passage of time, or what we call time decay and a potential increase in volatility, all with defined limited risk. Step 1: Market outlook and setup selection. Market view: you are looking for the underlying assets, that is stock or ETF, etc., to stay near a specific price point until the near term option expires and the potentially move higher. The legs: a long call calendar spread involves two call options. One short sell, near term call. This is the front month option, typically expiring in a few weeks or 1 month. You collect a premium for selling this. Buy long one for term call. This is the back month option, typically expiring 1 to 2 months after the short call. You pay a premium for buying this. Key: both calls must have the same strike price. Step 2: Execution and net debit. The trade: you execute this as a single transaction, a spread order on your brokerage platform. Net debit cost: since the longer term call which you buy has more time value than the starter tell call which you sell, the premium you pay for the long call will be greater than the premium you receive for short call. Formula: text maximum loss equal text debit paid equal text long call premium minus text short call premiums dollar. This net debit is your maximum risk. Step 3: the profit mechanism. Time decay, minimum profit goal. The core mechanism for profit is time decay. Options loss value as they approach expiration, and this decay is faster for short-term options. The short call decays rapidly, approaching zero value as its expiration date nears. The long call decays much slower. Ideal scenario for minimum profit: the underlying stock price remains exactly at the strike price. A. When the short call expires. The short call expires worthless, allowing you to keep the premium received. The long call retains its maximum time value as it is at the money ATM, that meaning, and you are now left with just a valuable long call position. You then close the long call for a profit, selling it for more than the initial debit paid, or sell another near-term call to roll the spread forward. Step 4. Managing risk and exit strategy. Maximum loss. Your maximum loss is limited to the net debit paid to enter the trade. This occurs if the stock moves sharply far away from the strike price, either very high, deep ITM, or very low, deep OTM. Caution both options to have very little time. Value left exit plan. Ideal exit. Allow the short call to expire worthless if this short in near the strike price. Then you are left with the long call, which you can sell for a profit or use to sell another near term call. Profit target. Close the entire spread early, buying back the short call and selling the long call if the spread value has reached your target profit, that is 50% of the initial debit. This is often done before the short call expiration to avoid assignment risk. Cryptocurrency options in the USA. Options trading on cryptocurrencies like Bitcoin or Ethereum is available to US traders through regulated exchanges such as the CME Group. For future options for platforms like LedgerX, back for physically settled options. The long call calendar spread mechanics are identical when applied to crypto options. You buy a longer term call and sell a short term call on the same underlying crypto assets, e.g. one Bitcoin call option contract with the same strike price, utilizing time, decay, and volatility expectation. A numerical example will make the profit mechanics of the long call calendar spread much clearer. Numerical example: long call calendar spread. Let's assume an imaginary stock XYZ Corporation is currently trading at $100. You believe it will remain near $100 for the next 30 days and then potential rise. You decide to enter a long call calendar spread using the $100 strike price, that is 80 M. The trade setup: opening position, leg, 5 columns, 1 leg, 2 action, 3 expiry date, 3rd strike price, 4th premium, 5th cash flow. 1 short call, 2 sell to open, expiry date 3 30 days, strike price $100, premium $3, cash flow plus 300 credit received. Long call, buy to open, second, 60 days, expiry date, strike price $100, $5 premium, minus $500 debit paid. Net debit paid maximum loss. Text net debit equal text long call premium minus text short call premium dollars. Text net debit equal $5 minus $3 equal $2. Text per shares. Total cost one contract 100, meaning $2 times 100 shares. That means math be $200. Profit and loss scenarios: 30 days later, short call expiration. The short call expires in 30 days and its value goes to $0. If the stock is below $100, the value of the long call 60 DTE becomes 30 DTE. Date of expiry is the key to profit scenario. One maximum profit ideal outcome. Stock price at 30 days, $100 exactly at the strike price. Short call 30 days, $100 call expires worthless. You keep the $3 premium collected. Long call original 60 days, $100 call now has 30 days remaining ATM. Let's assume its value only decayed slightly, and due to the high extrinsic value at ATM, it is still trading $4.50. Position value calculation, cash flow, 3 columns. Initial cost, position value meaning net debit paid, calculation meaning cash flow minus $2. Short call profit and loss, $3 collected minus $0 expired plus $3. Long call value sell at $4.50 plus $4.50 cash flow. Total profit and loss, long call value initial cost, $math B plus $2.50. That's mean minimum profit $2.50 times 100. Tax and shares mass, that meaning $250. 50% returns on the initial 200 debit. Scenario 2, maximum loss. Worst case, stock price at 30 days $90. Stock moves sharply down or sharply up to say $115. Both calls are deep out of the money. If the stock is at 90, both $100 calls have no intrinsic value and very little time value left. Short call 30 days, $100 call expires worthless. Long call original 60 day, $100 call value collapse at almost zero. Easy $0.05. Closing the trade, you close the long call for $0.05. Position value calculation, cash flow, 3 columns is there. Initial cost, net debit paid minus $2. Short call profit and loss, $3 collected minus 0 expired plus $3. Long call value sell at $0.05 plus $0.05. Total profit and loss $3 plus $0.05 minus $5. Math B, $1.95. Maximum loss, math B, $195, very close to the full initial debit paid, if $200. Key profit driven differential, time decay sheet, theta. The success of the long call calendar spread hinges on the difference in time decay. The short call is closer to expiration, so its theta is high, it decays fast. The long call is further from expiration, so it is theta is lower. It retains value better when the stock price stays near the strike. The rapid decay of the short call is what generates the potential profit, allowing you to buy it back cheaply or let it expire worthless, leaving you with the valuable long call. This visual shows the tent shape where the peak profit occurs exactly at the strike price, $100 in this example, on the short term options expiration date. And another, equity shares, 3 growth stocks under $20 in USA equity shares. Disclaimer: investment recommendations can be outdated quickly. The stock prices and targets below are for informational, illustrative purposes based on recent analytical and market views and should not be considered personalized financial advice. Please conduct your own due diligence. Company name, present price range and description, growth description and target price. This is 4th columns. Company name, Sophie Technology. Price range $7 to $9. This is Sophie FinTech Disruption, a one-stop shop digital platform for banking, loans and investing. Growth is driven by accelerating user acquisition, expanding its product ecosystem, financial service product loop, and achieving GAAP profitable. Target price is $12 to $15. Second company is Wisdom Tree, that meaning WT. This current price is $6 to $8. ETF digital assets focus, a global financial service company specializing in ETFs and exchange traded products. Its growth is powered by the overall demand for low cost ETFs and its early move into blockchain based financial service via its Wisdom Tree Prime app. Target price is $10 to $11. Third company is Teva Pharmaceutical. Current price is $10 to $12. Debit reduction and generic leadership, a global pharmaceutical company. Its growth is contingent on successfully executing its massive debit reductions plan, leveraging its strong position in the generic and special drug market and successful new product launches. 13 to target price $13 to $16. Please like, subscribe and comment. Another 3.5 minute video, hot touchable video. You will find out what is that.
The long call calendar spread is a sophisticated options trading strategy that involves buying and selling call options with the same strike price but different expiration dates. In the context of cryptocurrency markets in the USA, this approach allows traders to potentially profit from time decay and volatility shifts. By purchasing a longer-term call, and simultaneously selling a shorter-term call, investors can benefit from the differing rates at which option premiums erode. This strategy is particularly useful in markets where price movement is expected, but the timing is uncertain. Understanding the mechanics of the long call calendar spread is essential for those looking to manage risk and optimize returns in the dynamic world of crypto options trading. To execute a long call calendar spread, begin by selecting an underlying asset and identifying two call options with the same strike price but different expiration dates. Purchase the longer-term call and simultaneously sell the shorter-term call. This creates a position that benefits from time decay and stable prices. Risk management involves monitoring the spread's value and setting stop-loss levels to limit potential losses. To target minimum profit, calculate the net debit paid and plan to exit the trade when the shorter-term option nears expiration, ideally capturing the maximum time value differential. Visual diagrams will illustrate the setup, showing the overlapping options and the profit zone as the underlying price approaches the strike price at the first expiration. Let's explore three promising growth stocks currently trading under $30 per share. The first company, XYZ Technologies, specializes in cloud-based solutions and has reported consistent revenue growth over the past year. Next, Greenwave Energy focuses on renewable energy projects and recently secured several new contracts, boosting investor confidence. Finally, Urban Eats is a fast-growing food delivery platform expanding into new markets. Analysts have set ambitious target prices for each of these stocks, reflecting their strong potential for future growth and market expansion.
Yes.
I will receive
The long call calendar spread.
Yes.
Please subscribe and grow Google Ads creators. Stocks buy or sell. Long call calendar revealed. 3. Stocks equity shares under 20. Skyrocket. Call options contract. Calendar spread secret. PLTR. Sophie RVM. Call spread strategy. Unlock $20 stock profit. Please like, subscribe and comment. Any comment I will positive receive. Please comment. Once again I have said we will meet tomorrow next video. Thank you my dear friends.